When markets fall, most investors see chaos, but Benjamin Graham saw clarity. To him, a bear market wasn't a reason for fear, it was a time for opportunity. When the noise of speculation faded and the true worth of businesses could finally be seen. I often imagine the scenes he must have witnessed on Wall Street. Brokers shouting across crowded trading floors, ticker tapes spilling like confetti, and ordinary people watching their life savings disappear in real time. In those moments of panic, Graham didn't see disaster. He saw a natural cleansing of excess, the resetting of prices back toward reality. He believed that markets, like tides, are governed not by logic, but by emotion. Prices rise when greed overpowers reason, and they fall when fear takes hold. Yet beneath those waves lies something steady. Real value, built on earnings, assets, and human enterprise. That's what Graham sought. He called his approach value investing. But at its core, it was about temperament more than technique. He taught that true investors must remain calm when others lose their nerve, and rational when the crowd is irrational. That's what separates speculation from investment. Even today, in our world of instant trades and algorithmic panic, the same psychology rules. The faces on trading screens have changed, but human behavior hasn't. In every crash, there are sellers driven by fear and a few buyers guided by discipline. In this reflection, we'll uncover how Graham found bargains in times of despair, how he developed a method to separate real opportunity from illusion. You'll see how his principles, born in the wreckage of the Great Depression, still guide investors through crises like 2008 or 2020. But before Graham could teach the world how to profit from bear markets, he had to endure one himself. And what he experienced would shape the very foundation of modern investing. Because before there was wisdom, there was loss. And before there was clarity, there was chaos. But what happened next would challenge everything even Graham believed about investing. In the roaring 20th century, Wall Street was a theater of optimism. Stocks seemed to rise without end, and speculation became the national pastime. Benjamin Graham was already a respected analyst by then, a man of intellect and discipline, studying financial statements when others chased rumors. He built a small fortune through careful research and a sharp mind. By 1929, he had every reason to believe his system worked. And then, the crash came. In a matter of weeks, prices that had taken years to climb collapsed like a house of cards. The Dow Jones fell nearly 90% from its peak. Fortunes vanished overnight. And Graham, despite all his skill, wasn't spared. His funds suffered devastating losses. Companies he thought were solid dissolved under the weight of panic and debt. It was during those dark years, when the market seemed beyond reason, that Graham began to see the truth that would define his entire career. Price is not the same as value. He realized that the market is a voting machine in the short term, but a weighing machine in the long run. In moments of euphoria, investors vote with their greed. In bear markets, they vote with their fear. But the true worth of a business, its earnings power, its tangible assets, its capacity to survive, remains far steadier than the crowd's emotions. Graham began to think differently. If panic could push good companies to absurdly low prices, perhaps the intelligent investor could step in, buying when others were too afraid to act. The crash, in all its devastation, became his greatest teacher. He studied balance sheets by candlelight, looking for companies whose market prices were less than their liquidation value, the amount shareholders would receive if the business closed tomorrow. To him, that was the essence of safety, buying assets for less than they were worth.
While others fled the market, Graham returned with sharpened discipline. He wasn't hunting for glamour stocks or chasing recovery rumors. He was searching for neglected, undervalued, and misunderstood businesses. Companies priced not for perfection, but for survival. The difference between speculation and investment, he concluded, was simple. Speculation looks for price movements. Investment looks for value. Nearly a century later, his words still ring true. Think of the dot-com bust of 2000, the financial crisis of 2008, or even the pandemic crash of 2020. Each began with optimism turned to panic. Each offered chances to buy great businesses at a fraction of their worth. But only those who remembered Graham's lesson, price is not value, were able to see through the noise. It was in those painful years after 1929 that Graham built the foundation of his philosophy. He understood that the market could break hearts and fortunes, but also that in its darkest hours it offered its brightest opportunities. And from that realization emerged the cornerstone of his method, finding a margin of safety. But what exactly does that mean, and how does one measure the unseen worth of a company? The answer would become one of Graham's greatest contributions to investing wisdom. To understand how Graham bought bargains in bear markets, we must first understand what he meant by value. To him, a stock wasn't just a piece of paper or a digital ticker symbol. It was a share in a real business with real assets, real earnings, and real people running it. He called the true worth of that business its intrinsic value. Unlike market price, which swings with emotion, intrinsic value comes from cold, hard analysis. It's determined by what the company owns, what it earns, and what it's likely to earn in the future. But Graham also knew that no one could calculate this value with perfect precision. Markets are unpredictable, and even the best analysis can be wrong. That's why he introduced one of the most enduring ideas in all of finance, the margin of safety. The margin of safety is the cushion between what something is worth and what you pay for it. In Graham's words, the essence of investment management is the management of risks, not the management of returns. He taught that the intelligent investor should buy only when a stock is priced so far below its estimated value that even a miscalculation, a downturn, or a surprise wouldn't lead to permanent loss. In the 1930s, when the market was littered with broken companies, Graham found opportunities few others dared to touch. One of his most famous examples was Northern Pipeline, a company trading for far less than the cash and assets it owned. He realized that if the company were liquidated, shareholders would receive more than the market price of the stock. That was a true bargain. He bought, waited patiently, and was eventually rewarded when the value was recognized. This method wasn't about timing the market or predicting the economy. It was about mathematics and patience, buying assets for less than they were worth and allowing time to do the rest. Modern investors might recognize this same logic in the aftermath of the 2008 financial crisis or the 2020 pandemic crash. Quality companies like Johnson & Johnson, Microsoft, and Disney traded at deep discounts to their long-term potential. The headlines were filled with panic, but the numbers told another story. Those who applied Graham's principle of margin of safety were able to buy when fear was greatest and were rewarded as markets recovered. What makes the margin of safety timeless is its simplicity. It doesn't depend on prediction, it depends on preparation. By insisting on a large gap between value and price, an investor gains the one thing markets can't offer: protection against uncertainty.
As Graham often said, the future is uncertain, but the margin of safety gives you a fighting chance. Even today, amid digital trading and financial algorithms, this idea remains the bedrock of sound investing. Because while technology changes how we trade, it doesn't change the fact that emotion drives prices away from reality. Graham's method was never about finding perfection, it was about finding enough protection. But Graham's real genius wasn't only in discovering undervalued stocks. It was in the mindset he built around them, a way of thinking that could withstand the panic of crowds and the temptations of greed. And that mindset became the very soul of his philosophy, the discipline of value. If numbers were Graham's tools, discipline was his armor. He understood that the greatest enemy of the investor was not the market, but the investor himself. Fear and greed, he said, destroy more wealth than recessions or bankruptcies ever could. To teach this lesson, Graham created one of the most famous parables in financial history, the story of Mr. Market. Imagine, he said, that you own a small business with a partner named Mr. Market. Every day, Mr. Market offers to buy your share or sell you his. Some days he's optimistic and quotes a high price. Other days he's depressed and quotes a very low one. The key, Graham taught, is that you are never obligated to act. You can choose to ignore him until his offer makes sense. Mr. Market, of course, is a metaphor for the stock market itself. Its moods swing wildly, but its offers are only dangerous if you take them too seriously. The intelligent investor doesn't react to every change in price. He acts only when the price diverges meaningfully from value. During the Great Depression, when despair ruled Wall Street, Graham applied his own lesson. While newspapers screamed about the end of capitalism, he quietly analyzed balance sheets, searching for companies whose intrinsic worth remained intact despite collapsing prices. His calm detachment was not indifference, it was discipline. That same mindset inspired one of his most successful students, Warren Buffett, who later said that reading The Intelligent Investor changed his life. Buffett internalized Graham's message. The investor's chief problem, and even his worst enemy, is likely to be himself. The lesson resonates even more strongly today. When algorithms move markets in milliseconds and social media spreads panic faster than reason can catch up, the temptation to react is stronger than ever. Yet Graham's advice still holds. Let the market serve you, not instruct you. He used to tell his students that the market is there to provide opportunities, not guidance. When it offers foolishly low prices, you buy. When it offers absurdly high ones, you sell or do nothing. But you never let its mood dictate your own. It takes extraordinary patience to act that way. In 1932, when most investors swore off stocks for good, Graham continued his steady search for value. He bought selectively, sometimes holding positions for years before they were recognized. He trusted the math more than the mood. We saw this same discipline rewarded in 2020, when markets plunged amid uncertainty. Some investors fled. Others, guided by the same temperament Graham taught, bought great businesses at fire sale prices. 1 year later, they saw the wisdom of his approach confirmed once again. Temperament, not intelligence, became the ultimate test. As Graham wrote, to achieve satisfactory investment results is easier than most people realize. To achieve superior results is harder than it looks. He knew that success in bear markets wasn't about brilliance, it was about balance. Staying rational when others were fearful required not just knowledge, but humility. And yet, even for Graham, this discipline would face severe tests. Because for all his insight, he still made mistakes. Mistakes that would reshape his understanding of what safety truly meant. What happened next would refine his philosophy, teaching him lessons that numbers alone could never reveal.
Even the greatest teachers are shaped by failure. For Graham, the market was a stern but fair instructor. It rewarded patience, punished arrogance, and never stopped testing conviction. In the years following the Great Depression, Graham's approach began to attract attention. His methods were working. He had turned disciplined analysis into profit, while many others were still licking their wounds. Yet success brought new challenges. Not every bargain turned out as he hoped. Some of the companies he bought for less than their liquidation value never recovered. A few went bankrupt before the market ever recognized their worth. The numbers had promised safety, but the reality of poor management, dishonest accounting, or obsolete industries showed him that cheapness alone was not enough. It was a painful realization. Graham had built his early philosophy on the belief that buying below tangible value guaranteed protection, but experience proved otherwise. Some assets weren't truly worth what the balance sheet claimed, and some businesses deserved their low prices. This period forced him to evolve. He began to refine his method, no longer seeking only statistical bargains, but also judging the quality of the enterprise behind them. He studied management competence, earnings stability, and the nature of a company's business model. The numbers were still crucial, but now they were only part of the story. He also learned the importance of diversification. No matter how confident he was in a single investment, he understood that uncertainty was inevitable. By spreading risk across many undervalued securities, he could absorb the occasional failure without derailing the whole portfolio. These refinements marked a turning point. Graham began to view value investing not just as a science of calculation, but as an art of judgment. He balanced cold analysis with a respect for the unknown. He once said, "The function of the margin of safety is, in essence, that of rendering unnecessary an accurate estimate of the future." Modern investors can see his lessons echoed in what we now call value traps. Stocks that appear cheap but remain stagnant because their underlying businesses are weak. Graham encountered those traps long before the term existed, and it was through them that he developed a deeper appreciation for quality. His evolution also laid the foundation for his later students. Warren Buffett famously adapted Graham's quantitative framework into a more qualitative approach, buying wonderful businesses at fair prices, instead of just fair businesses at wonderful prices. That progression began with Graham's own humility and willingness to learn from loss. By the time the 1940s arrived, Graham had weathered 2 market crashes, rebuilt his wealth, and honed his philosophy into something both timeless and human. He no longer saw bear markets as disasters, but as inevitable, necessary, and even beneficial. Every downturn, he realized, served the intelligent investor by creating mispricings born of fear. And those moments, when everyone else fled, were the times to buy with courage and clarity. From failure came wisdom. From fear came opportunity. And out of those hard lessons, Graham reached one of his most counterintuitive conclusions: that the best time to buy is precisely when the world seems least interested in buying. This paradox would become the defining insight of his career, one that remains just as powerful in today's volatile markets. Because, as Graham discovered, it is in the depths of a bear market that the seeds of great fortunes are quietly planted. To most people, a bear market feels like a storm, unpredictable, destructive, and best avoided. But to Graham, it was a gift wrapped in panic. He believed that falling prices were not a sign to flee, but an invitation to invest more wisely. It was, as he called it, the paradox of fear, that the moments when investors feel most uncertain are often when the best bargains appear.
In his calm and deliberate way, Graham pointed out a simple truth. Lower prices mean higher potential returns. When the market's mood turns dark, when the news is grim and pessimism fills the air, that's when the intelligent investor begins to look for value. He once wrote, "The intelligent investor is a realist who sells to optimists and buys from pessimists." To Graham, pessimism was a source of profit. Fear pushed good companies far below their intrinsic worth, creating opportunities for those who had the courage to look beyond the headlines. During the 1930s, when the market was a wasteland of bankruptcies and despair, Graham quietly accumulated shares in companies whose balance sheets remained strong. His logic was simple. The economy might falter, but solid businesses with real assets and consistent earnings would eventually recover. And when they did, the investor who had bought during the darkest days would see extraordinary gains. History vindicated him. As markets recovered in the late 1930s and again after World War II, those who had followed Graham's discipline saw their patience rewarded. While the majority had sold in fear, the minority who bought in faith reaped the profits. This same pattern has repeated in every generation. In 2009, after the global financial crisis, great companies were trading at prices no rational investor could have imagined just a year before. Yet few stepped forward to buy. The fear was too fresh, the wounds too deep. And in 2020, amid the uncertainty of the pandemic, the pattern returned. Panic selling followed by swift recovery. The intelligent investor, Graham would say, must detach emotion from action. It is not about being fearless, but about acting rationally despite fear. He knew that courage in investing is not the absence of doubt. It is the ability to think clearly while others cannot. Bear markets are also the ultimate test of conviction. When prices fall, Graham's teachings remind us to ask, has the business itself changed, or only the market's opinion of it? If the company remains sound, the lower price is a gift, not a threat. In this way, Graham turned the entire logic of the market upside down. Where others saw danger, he saw opportunity. Where others saw loss, he saw value waiting to be recognized. Every bear market, he believed, carries within it the seeds of the next bull market. It's not prediction, it's human nature. Fear creates mispricing, recovery corrects it. The intelligent investor's role is to stand ready when the pendulum swings too far. Even now, nearly a century later, this paradox of fear remains one of his most enduring lessons. Technology may have changed, but emotion has not. Markets still move on waves of hope and despair, and it is in those waves that value investors find their strength. But Graham's wisdom didn't end with analysis or courage. He believed that principles are only as powerful as the actions they inspire. Knowing when to buy is important, but knowing how to act, how to think, and how to endure is what truly defines the intelligent investor. And that leads us to the final piece of his philosophy, the enduring wisdom that transforms bear market lessons into lifelong discipline. Because in the end, Graham's greatest gift to us wasn't a formula, it was a way to think. After a lifetime of market cycles, Benjamin Graham left behind more than formulas or financial theories. He left a philosophy of calm, reason, and self-mastery. His ideas weren't built for a particular decade or market condition. They were built for human nature itself. He taught that investing is not about beating others at their game. It's about controlling yourself within your own. Bear markets, he believed, are the ultimate proving ground of that control. They test patience, discipline, and conviction far more than intelligence.
So what can we, modern investors, in a world of constant information and rapid change, still learn from him? The answer is simple yet profound. First, analyze businesses, not prices. Graham insisted that every stock represents a share of an actual company, producing goods or services, employing people, and earning profits. When prices fall, don't look at the red numbers on the screen. Look at the business behind them. Ask whether its fundamentals are still intact. If they are, the market's panic is your opportunity. Second, demand a margin of safety. Never assume your analysis is perfect. Buy only when the price is comfortably below your estimate of value. This cushion protects you from both market volatility and your own fallibility. It's the single most effective way to turn uncertainty into advantage. Third, let emotion serve you, not rule you. Markets are driven by psychology as much as by numbers. Graham's parable of Mr. Market teaches us that we don't have to react to every swing in sentiment. Instead, we can choose to wait for the right offer, the one that favors reason over emotion. In practice, this means accepting that downturns will come. Prices will fall. Pessimism will dominate the headlines. But these moments are not failures. They are opportunities dressed in fear. The investor who remains steady, guided by analysis rather than emotion, will find value where others see only despair. Think of Graham's lifetime: the Great Depression, world wars, recessions, inflation, political upheaval. Through it all, he stayed loyal to the same principles. He didn't predict the future, he prepared for it. And that mindset is what allowed him and those who followed his teachings to thrive across generations. His ideas shaped legends like Warren Buffett, Irving Kahn, and many others. Yet Graham himself remained humble, often reminding his students that no system is foolproof and no investor infallible. To achieve satisfactory results, he wrote, you must act with a margin of safety and a margin of humility. That humility might be the most timeless lesson of all, because in markets, as in life, certainty is an illusion. What matters is preparation, patience, and the discipline to act rationally when others cannot. Even in today's world, filled with AI-driven trading, endless data, and global volatility, Graham's wisdom remains as relevant as ever. When fear grips the market, step back and ask, has human nature really changed? The answer, of course, is no. People still chase euphoria and flee despair. And that's exactly why value investing will always endure. So the next time a bear market arrives, and it always will, remember Graham's calm voice beneath the noise. The intelligent investor welcomes falling prices, for they bring the chance to buy true value at a discount. In the end, Graham didn't just teach us how to invest, he taught us how to think, patiently, rationally, and independently. His lessons transcend finance. They are lessons in human behavior, discipline, and perspective. Markets will rise and fall. Economies will boom and break. But those who understand Graham's teachings know that the cycle itself is not the enemy. It is the rhythm by which opportunity reveals itself. In every bear market, somewhere, a bargain waits quietly to be discovered. The question, as Graham would remind us, is not whether the market will recover. It always does. But whether you will have the patience, courage, and clarity to seize that moment when it comes. And that is the timeless secret of buying bargains in bear markets. The same one Graham discovered nearly a century ago, and the same one that continues to guide wise investors today. Because while markets change, wisdom endures. And in every era, the teachings of Benjamin Graham remain the calm amid the storm.